And I just got a little backlog of videos to do, so I got to do one more. This is from that Sovereign Man guy. I've mentioned him several times in my videos. At sovereignman.com. He offers a newsletter as well. Wealth management, newsletters, investment, things like that. But to subscribe, just to get the emails, it's free. And he's always got these great, like stories to tell about something that he experienced or back when America was this, he comes up with this great stuff. But he's got another one that it's right in line with what I've just been talking about recently. I understand Trump's in there, but the stock market finally breached 20K. Every time we have these like new highs, it's not long after that a crash comes. And the one he's going to give you in this example was the 2000 crash, but it didn't come right after the all-time high was hit. It did take several months, but it did come. And that's the point, and that's why I want to read this to you. On March 30th, 1999, the Wall Street Journal's front page headline blasted the good news across the world. Dow Industrials top 10,000. Kind of ironic, 10, 20, 30, 10,000. Now we're at 20,000. Kind of ironic. Dow Industrials top 10K, 10,000. The day before, the all-time important U.S. stock index, the Dow Jones Industrial Average, closed above 10,000 for the first time in history. It was a major milestone, and investors cheered. A few investors, however, were concerned. Kind of reminds you of the 2005 and 6 thing. A few of us were concerned about the housing. They said not to worry about it. And some of those people made gobs, enormous amounts of money, because they were the only ones who thought outside the box, not even necessarily outside the box being mainstream media and the complicit government together, but outside that box and seeing it for what it was. We got a problem here. This is not sustainable. People aren't going to be able to afford these huge payments with the housing going way up. Everybody's approved. People even without jobs, this is not going to end well. I'm going to short that system. And they did, and they became the winners while the rest of us suffered. Not their fault. It was going to happen anyways. So if you have the foresight, capitalize. So, a few investors, however, were concerned. They felt that U.S. stocks were too expensive, and the entire market was in a dangerous bubble. But the Wall Street Journal answered those naysayers as the headline of the second article on the front page ominously read, "If this is a bubble, it is sure hard to pop." They were right. Well, sort of. The Dow Jones Industrial Average continued to climb for the next 8.5 months. But on January 14th, 2000, it peaked and then started a horrible 2-year decline that wiped $5 trillion of wealth from investors. Let me interject, if I may. This is the year 2000. How much money was printed 2008, 2009, TARP funds, trillions in bailouts, trillions to the banks, backdoor trillions more to the banks and offshore in the foreign banks. And now we're in 2017. If this happens again, do you think it's going to wipe off a mere $5 trillion? You didn't normally hear numbers like that in the year 2000. I'm expecting to hear something like, $25, $30 trillion wiped off, maybe even more. Yesterday, the Dow Jones Industrial Average hit another major milestone, 20,000. You might have even heard the sound of champagne bottles being simultaneously uncorked by jubilant traders at 4 p.m. Eastern Time. But Dow 20,000 should give any rational individual pause to reflect on the possible consequences. After all, the single most important characteristic of any investment is the price when you buy it. Doesn't matter how spectacular your investment is. If you overpay for it, you have no margin of safety. And as the market affirmed yesterday, U.S. stock prices can be expressed in a single word: expensive. It's not the fact that the Dow hit 20,000 that makes U.S. stocks so expensive. The price of a stock alone doesn't tell you much. It's important to look at the price of the stock relative to other important metrics like cash flow, book value, sales, earnings, etc. unless you just turn on the news, mainstream. It'll just tell you healthy economy means a high stock market. That's automatically. That's all you need to know about. And in other news, U.S. stocks right now are selling at the highest price to sales ratio in at least 15 years, and far higher than that than it was before the 2008 crash, by the way. Similarly, the cyclically adjusted price/earnings ratio of the U.S. stock market is now at its highest level since the 2000 crash, and higher than it was before the 2008 crash. Looking at other metrics like enterprise value to EBITDA, which is a measure of a company's core business operating cash flow, U.S. stocks are also at their most expensive levels since the 2000 crash. Certainly, U.S. stocks could continue to become more expensive. Perhaps they could go up forever. Or perhaps an astute investor should start looking for a margin of safety. One significant measure of safety is a company's price/book ratio. This is essentially a reflection of how much an investor is paying relative to the value of a company's quote-unquote net worth. And this matters. In his book, What Works on Wall Street, author James O. Shaughnessy conducted an analysis of the investment strategies that were the most and least successful in the U.S. stock market for a period of over 50 years. One of the most successful strategies? Buying companies with low price-to-book ratios. One of the least successful strategies? Buy companies with high price-to-book ratios. Over the long run, value investing beats just about everything, and these extremely high multiples in the U.S. market clearly do not qualify as good value. This is not to say that the entire U.S. market is overvalued. There are still pockets of value in North America, but they are becoming much more difficult to find. Looking abroad, however, there are a number of other markets overseas where valuations are much more attractive. If North America stands out by way of high valuations, for example, Japan stands out by way of low and attractive ones. 1/3 of the entire Japanese stock market has a cash flow yield, which is enterprise value / cash from operations, of over 15%. No other developed market comes close to that. And as analysts from European Bank Societe Generale point out, Japanese companies also have more net cash than listed businesses in any other country. More importantly, Japanese companies are being actively encouraged to pay higher dividends and buy back their shares, whereas the balance sheet of U.S. companies are groaning with years of accumulated debt. Japanese balance sheets are the healthiest in the world, and they are awash with cash to give back to their shareholders. Japan is very enticing to value investors, and it's a great example of how looking abroad and expanding your thinking to the entire world can yield very compelling results. P.S. Our analysts at the Fourth Pillar Investment Alert Service have found a profitable Japanese company whose stock price is so cheap it's selling for less than the amount of cash the company has in the bank. Plus, the company is already paying a strong dividend. This strategy is a no-brainer. Don't miss out on the next edition of the Fourth Pillar or the chance to subscribe at an incredible 45% discount. This special offer ends tomorrow, which unfortunately is over by the time you hear this. But this again is Sovereign Man, which is, let's see if I can find his actual link. It's clicking to, it's just sovereignman.com. He's got good articles all the time. That's why I like subscribing to a few, a couple of sources, but he's one of them. I enjoy the fact that he gives you some nuggets free of charge, and then says, hey, if you want my subscription service to make some, some bets, so to speak, on stocks or whatever, some investment advice, sign up to the newsletter. I'm not doing that. Not because I don't trust this guy. I just don't like playing markets, period. The paper game. Because if you go online and buy a stock, you're going to use some kind of trading platform. Well, come to E-Trade or Options Express or whoever. What happens in a gigantic meltdown? Is it possible that the company you're using goes under because everybody else or most everybody got margin calls and are trying to liquidate as fast as they can, but they can't come up with the money they need to be whole again? The company's going to go under, but all your profits in your account look great because you played it right, but you can't get it because the company's going bankrupt. Now, we did see that happen with MF Global, John Corzine. But in the other previous stock market crashes, 2008, 2000, I don't know that this happened necessarily. I haven't done the research either to find out whether specific brokers or trading companies that we can go online and trade that went under and people lost. I have to admit I don't know for 100% sure if that has happened yet. It certainly can happen. But if it hasn't happened in the last two, and I know this is supposedly the big one that we're waiting for, could it happen in this one? The answer is sure it could, but it may not, and you may still have a chance of making some good returns on the investment. So I would just say, it's probably a good place to sign up to and see what his portfolio looks like, I guess. But I want to, just while I'm here, see if I can figure out what it even costs. Matter of fact, I can do it in the email because he says a 45% discount that's expiring. So I'm trying to find out where is the actual price? How much? Whoa. Ooh. That's why an annual subscription to the fourth pillar costs $1,795 a year, but not today. Take $800 off. Total price $995. That's a big chunk, but if I had to do this or Bull Pony, I'd pay the full $1,700 price here in a hurry. Take care.